Hello and welcome. This is the second of our videos on the operational case study preparing for May 2018. Here we have the handbag manufacturer and Mansako, and this time we're going to be looking at tax. My name's Sandy Hood and welcome back. The F1 syllabus topic includes tax, and we need to be able to apply the rules from IFRS to generate appropriate accounting entries in respect of accounting for taxation. And we're looking at this in the case of Mansako, and we're looking at IAS12 Income Taxes. Now, the background F1 knowledge, you should know by now that accounting profit and taxable profit are not the same, and that the accounting profit is a profit or loss for a period before deducting tax expense. It's consistent, but of course the background in the calculation of the accounting profit is different to the background in the calculation of the taxable profit. And the taxable profit or loss is for the period has to be established by the taxation authorities upon which income tax are payable or recoverable. Now we know that we're in lower land, so that's the tax authorities there, and we know that we're dealing with a corporate tax rate of 20%. Accounting rules generally apply in lower land, but there are certain expenses that are not allowable: accounting depreciation, amortization, entertaining expenditure, political party donations, and taxes paid to other political bodies. The tax regime also has tax depreciation allowances. These are available on items of plant and equipment, and there's tax losses that can be carried forward to offset against future taxable profits from the same business. So there's clearly a lot of information about tax in relation to Mansako and lower land. Here we can see the profit or loss for Mansako for the 2 years, 2017-2018, and taxes featured here. Interesting, a big difference in terms of the accounting profit, which we've already discussed is not the basis for calculation of tax, but we have a big difference that 33.8% of the accounting profit is being charged as tax, whereas the previous year 56.8%. So there must be something quite fundamental that has caused this difference. The percentages themselves are probably not useful, but they highlight a difference, and it's worth it for us to look at. And it would be ideal for the examiner to be able to present a question on this because there is such a big difference. We know that tax is chargeable on taxable profit, and the statement of profit or loss tax figure includes under and over provision adjustments from previous years. So we get a clearer idea of the tax for the year when we look at the statement of financial position. And here we have it within the current tax liabilities: 1,634 for this year, 3,044 for last year. So the tax for 2017 has been estimated, and that's what's been reported. Now we can see how much tax was actually paid, and 4,716 was paid in 2017, and the same numbers but in different order: 4,761 paid in 2016. So having highlighted that, I thought it was useful to then put together a little T account so we could see what had gone on. So the balance brought forward on the 1st of January 2017 was 3,044. We then paid 4,716. Now that indicates that there'd been an under provision. So the 2016 figures had been under provided by the difference. So 1,672 was an under provision from the previous year. The estimate for this year we've seen shown in the statement of financial position, 1,634, which is why our statement of profit or loss this year is showing 3,306. And of course the balance carried down is the fact that it hasn't been paid yet, so it's sitting within our current liabilities. So we can see those figures that they've given us have told us that there was a significant under provision last year. Now, if we quickly revisit the syllabus, it's telling us a lot of the same information that we've already got from the lower land information. Produce corporate income tax computations for a given set of rules, distinction between the two types of profit, and including the various different things that can be exempt, and replacement of accounting depreciation with tax depreciation, and the calculation of tax depreciation allowances. We're obviously not going to be asked to do any calculations, but we may well be asked to do some interpretation. So I want to know if you're ready for a practice taxation question. And here this question would typically be one task of 2 within a 45-minute section. And I would allocate an equivalent, within 45 minutes I'd be looking at 9 or 10 minutes for planning. So if we're doing a half of a section, then I would be allocating 5 minutes for a plan, 18 minutes for writing up the answer. Anders Bucati, we know who he is, he's the Chief Executive Officer, and he says, "Hello, Finance Officer, we made $6,487,000 profit in 2017, which he's probably very proud of. I know that corporate tax rate's 20%, and I borrowed my daughter's calculator to find a value of $1,297,400. Why does our statement of profit or loss state that our tax this year is $3,306,000? Well, that's the question. You must answer the question. You don't need to remember numbers, but you do need to have the understanding. How do I identify the question? Well, we need to, first of all, we need to identify the question, then we have to plan our answer, check it, and quickly write up a series of short paragraphs to match the plan. So how do we identify the question? Well, why is it that our statement shows that particular tax figure? Plan it. You can use a scratch pad. I don't recommend it. I recommend going straight into the word processing document. So that's the planning. Here's the start off. A typical answer sheet where we would start to put in our headings. Profit before tax or profit for the year. Remember, he's given us a profit for the year figure that he's then worked 20% on. Accounting profit or taxation profit, disallowed expenses, tax depreciation allowances, tax calculation, and under and over provision. So why does our statement of profit or loss state that our tax this year was 3.3 million? Well, profit before tax was needed as a start. Taxable profit is used, which we can have differences from the accounting profit. And tax paid is based on the tax authority calculation, which can mean our estimate is over or under. And we need to adjust our charge for that in the following year. Good. So that we've made a plan and we have started to get ready to answer it. Work fast now. We have 14 minutes to try and write all our answer, and I'll quickly go through this. We've got about a minute and a bit left within this particular video. So here's our headings, straight in with a paragraph on the profit before tax and the profit for the year. So we know that we're dealing with the profit before tax whenever we're doing a calculation of what the taxable profit is going to be. Then we look at the taxation profit, not the accounting profit. We take into consideration disallowed expenditure. We look at what could cause disallowed expenditure without really going into any detail. Then we look at the tax depreciation allowances and the recognition that we're dealing with a slightly different depreciation than perhaps the accounting approach. Then the tax calculation timing, which brings in the area of the tax current liability. So why did our SPL state the tax was 3.3 million? What did we do? We followed this process. Identify the question, plan the answer, check the plan answers the tax requirements, and quickly write up a series of short paragraphs. We saw that the planning included disallowed expenses that didn't apply to Mansako. Right, this is an important point. The examiner wants you to answer the question. So if we've got something like that, then we don't need to give any detail because we're not going to earn any marks. Anders Bukati has asked us not to show off our knowledge of tax. He's asked us to answer a question specifically about Mansako. So we must write our answer about Mansako. Try to imagine possible questions that your managers at Mansako could ask you. Practice planning and then writing up your answers. I hope to see you for our next introductory recording. Thank you very much.